Hello everyone, here is the answer to exercise 2 from Unit 1 in AC201. Exercise 2 is all about adjusting entries, things that happen without a transaction being involved. And the first example we have is that Davis Golf Supply prepaid $14,400 for 1 year's worth of rent on January 1st. So that happened in the past and it's on our books. But still, as time passes, we're going to have to account for this rent. We're going to have to record, in this case, the adjusting entry to recognize the expiration of May's portion of this prepaid rent. Well, what two accounts are being affected? We can't record an expense unless it's in the period in which that expense helps us earn revenue. In other words, May's rent is going to help us earn revenue in May, so we need to record May's portion of the rent in that month. So one of the accounts being affected is going to be rent expense. And the rent expense, that prepayment of rent, is expiring because the month passed. So the other account has to be prepaid rent. What type of accounts are these? Well, rent expense ends in expense, so it's an expense. And prepaid rent, like all prepaid assets, is an asset. Are they increasing or decreasing? So rent expense, represents how much our company spent in total on rent during the period. And since this is more rent that we have to recognize, that's got to be going up. Prepaid rent recognizes how much rent we have on the books, which we've already paid for, but we haven't used yet. Well, we just used some of it. May expired, which means that has to be going down. And rent expense, like all expenses, is increasing with a debit. Prepaid rent is an asset going down, and all assets go down with a credit. So we know how to set up our journal entry. It's going to start with that debit to rent expense. But for how much? Well, to figure it out, what we're going to do is take the original amount of prepayment, and we're going to recognize the portion that's expiring. We paid $14,400 for 1 year's worth of rent. That's 12 months. Well, one of those months is expiring. May's expiring. So we need to recognize 1/12 of that total prepayment, which is going to come out to be $1,200. And that is the same amount of prepaid rent we're going to have to take off the books with a credit when we make our adjusting entry for the expiration of May's portion of this prepaid rent. In our second adjusting entry, we have equipment. Specifically, Davis Golf Supply has $52,000 worth of equipment that they purchased on January 1st. The company believes the residual or salvage value of this equipment is going to be $4,000. So that's how much money they're going to be able to get at the end of this particular asset's useful life. Speaking of its useful life, they estimate that it's going to be 16 years. So Davis bought this, is going to use it for 16 years, and when 16 years pass, they're going to be able to sell it for $4,000. Well, our books have to get this piece of equipment from its historical cost, what we paid for it, to what it's going to be worth at the end of its useful life. And we have to have some kind of method to do that. And the way we're going to do it is the straight line method of depreciation, which means we're going to take an equal portion away each month. So, what accounts are being affected? Well, we have depreciation occurring, and we get to recognize that expense during the month that it's depreciating. So depreciation expense is going to be one of our accounts. Our other account is accumulated depreciation of equipment. Under GAAP, we can't just reduce the value of the asset. We have to have an account tied to that asset which tracks how much value it's lost, and that's our accumulated depreciation account. What type of accounts are they? Well, ends in expense, so depreciation expense is an expense. Accumulated depreciation of equipment is an account which is tied to another account, and when something is tied to something else in accounting, it's referred to as contra. In this case, since it's tied to equipment, it is a contra asset. Depreciation expense is how much value we are recognizing our, assets have lost in total during the month, which means that has to be going up. Accumulated depreciation of equipment recognizes how much value our equipment has lost during the period. Well, it just lost more because we're recording depreciation entry, so that also has to be going up. Expenses always go up with a debit. Contra assets work the opposite of assets. So if assets go up with a debit and down with a credit, a contra asset would go down with a debit and up with a credit. So in our journal entry, we're going to start by debiting depreciation expense. For how much? Well, they're using straight line. So we're going to use the straight line formula. And to start with the straight line formula, you got to find what they call the depreciable base, the difference between its historical cost and its residual value. So we take $52,000 and subtract out that $4,000 residual value. In other words, this piece of equipment is going to lose $48,000 in value over its life, and we're going to spread that out equally over its entire life. Well, to do that, We're going to multiply it by 1 over its useful life, and then we're going to multiply it again by the number of months we're depreciating for over 12. So since it has a 16-year useful life, we're going to take that 52,000 minus 4,000 to come up with $48,000 depreciable base and multiply by 1 over 16 and 1 over 12. That's going to come out to be $250. And our credit is to accumulate depreciation of equipment for that same amount in this journal entry, which adjusts to record January's equipment depreciation. In the next adjusting entry, Davis Golf Supply, in the past, on May 1st, had received $2,400 in advance to repair golf equipment for the golf team at a local community college for the next 4 months. So we got paid in advance for something we hadn't done yet. But since we hadn't actually earned it, we can't record that revenue at the time. We owed something. We actually owed the services to this local community college golf team. We got to record the adjusting entry to recognize a portion of this deferred revenue that we actually earned during May. Well, what accounts are going to be affected? The first one is going to be unearned revenue. Like I said, at the time we signed this, we had not yet earned this revenue. We got the money, but we owed them something. We owed them work. And when we owe something, we have to put a liability on our books. Since in this case, we owed this particular service, we're going to put it on the books as unearned revenue, or you could even use unearned service revenue if you wanted to. I'm just going to use unearned revenue. And now that we're actually earning a portion of this, the other account has to be service revenue, which records the revenues that we actually earned during the period. What types of accounts are these? Unearned revenue, like I just said, is a liability, and revenue is a revenue account. Are they increasing or decreasing? So since we performed a portion of this contract, we don't owe this local community college as much work, which means our liability has to be decreasing. Service revenue tracks how much revenue we got from actually performing the service during the period while we worked on this golf equipment, we repaired it, which means we have to recognize more revenue. So liability going down, liabilities always go down with a debit, and we have a revenue account going up, and revenues always go up with a credit. So we're going to start our May 31st adjusting entry by debiting unearned revenue. Again, for how much? Well, there's a lot of different ways to go about revenue recognition, but we're going to do the easiest one for this. We're going to recognize it in a straight line, if you will, an equal portion each time, which is a perfectly viable way to do it if you think you're going to do about an equal amount of work each month over the contract's life. So originally, we got $2,400 for a 4-month contract. Well, since one of those months passed, we have to recognize 1/4 of that, which is $600. So we're going to reduce our unearned revenue liability account by $600 and move it into service revenue in this journal entry, which adjusts for revenues earned on an advanced payment contract. On May 31st, we have another adjusting entry, and it stems from a note payable that Davis Golf Supply had. So on May 1st, they signed the note. They took out a loan for $10,000, and it's at 6% annual percentage rate, and it is due in a term of 6 months. The note is going to be paid in full with interest on October 1st. We need to record the adjusting entry for the accrual of interest on this notes payable at the end of May. So what accounts are going to be affected? Well, we have to recognize expenses in the same period that help us earn revenue. We borrowed this money, we used this money during May, which means that interest that accumulated on the note during May helped us earn revenue in May. So we have to record that expense during the same period. So one of the accounts is going to be interest expense. And at this point, we know we owe it. Like, even if we paid this loan off early, our bank is still going to make us pay the interest that is accumulated for this 1 month of May. We can't just pay it back to $10,000. They're going to say, fine, you can pay it off early, but you still owe us this much interest. So we know we owe something. We have to put it on the books, and we're going to put it on a liability. In this case, that liability is called interest payable. We have one expense account and one liability account. Let's figure out if they're increasing or decreasing. Again, interest expense tracks how much interest all of our borrowing accumulated during the period. Well, we have an accumulation of more interest here, so that has to be going up. Interest payable tracks how much interest we actually owe to all the people we borrowed from. That also has to be going up. Expenses go up with a debit, and liabilities go up with a credit. So we know how to set up our journal entry now. In our May 31st adjusting entry, we're going to start with a debit to interest expense. One more time, for how much? Well, we're going to use the interest formula, which is principal times rate times time. We borrowed $10,000. The rate is 6%, and the time. how much time has passed? Well, 1 month has passed, so we're going to multiply that by 1/12. And if we take 10,000 times 0.06 times 1/12, we're coming up with $50. So we have $50 of interest that is accumulated on our particular note. At this time, we have to pay it off, even if we pay off our note early, which means we got to put it on the books. So we're going to debit interest expense for that 50. We're going to credit interest payable for the same amount in the journal entry, which adjusts for the accrual of interest on this note's payable. Next up, on May 31st, we have another adjusting entry, and this one is related to salaries. So Davis Gulf Supply's employees typically are paid $8,000 in combined salaries for a 5-day, Monday through Friday, work week. So that's how much we typically pay our employees at the end of every week. Well, the month doesn't always end on payday. In this case, May is going to end on Thursday, but Friday's payday. Our employees have worked 4 days since they were last paid. And again, we have to put expenses on the books in the same period that help us earn revenue. Our employees worked during May, even though we're not paying them, in this case, till June 1st. The portion of that payment that's going to come out on that date, some of it's attributable to May. There's those 4 days that they worked at the end of May, so we have to put those 4 days on our books during May. So for our adjusting entry, we got to record a salaries expense for the portion of, the time that they worked, which happened in May, and we owe them for this. So we're going to put it on the books as salaries payable. We have an expense and a liability. Salaries expense tracks how much our employees, got paid for the work they actually did during the month. So they worked more days, that has to be going up. Salaries payable is how much we owe to our employees for work they've already done. Well, that's got to be going up as well. And all expenses are going to go up with a debit, and all liabilities go up with a credit. So we have our journal entry set up. So on May 31st, when we make this adjustment, we're going to have a debit to salaries expense. And we're going to have the debit to salaries expense for the portion that we actually owe them, $6,400. How did I come about that? Well, it's easy enough. We have $8,000 that we typically normally pay. They worked 4 days, and they typically work a 5-day work week, which means 4/5 of that $8,000 was earned during the month of May. We have to put 4/5 of their next paycheck on our books during the month in which they actually earned those salaries. So 8,000 times 4/5 is how I got to 6,400 in this adjustment for the accrual of salaries. Next up, we have some bad debt. Davis Gulf Supply uses the percent of sales method to calculate its allowance for bad debt. During May, Davis had $125,000 worth of net credit sales, and they believe 5% of these sales are going to be uncollectible. No one ever collects all of the receivables owed to them, so we think 5% of that $125,000 worth of sales is never going to be seen. They already had an allowance for bad debt of $6,000 prior to making this adjustment. We got to make the adjusting entry now to get our bad debt to what it should be. Well, how are we going to do that? Again, we made these sales during the month of May. Bad debt is an expense related to the sales, which means we need to put the bad debt expense on the books in the same period that we recorded the sales. So we're going to have bad debt expense as one of our accounts. The other account is an account tied to our receivables, which shows people who are using our information what portion of those receivables we don't think we're going to collect, and that is called an allowance for bad debt. Bad debt expense is an expense. Allowance for bad debt is an account tied to another account, so it's a contra account, and it's a contra blah 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 for whatever type of account it's tied to. Well, it's tied to accounts receivable, which is an asset, so this has to be a contra asset. Bad debt expense recognizes the portion, amount of the sales that we've had that we don't think we're going to collect, and we're going to record the expense for in the same period. That's going up. Allowance for bad debt, again, is the same deal. It's the account tied to receivables, which shows the portion of those we're never going to see. That's also going up. And expenses go up with a debit, contra asset go up with a credit. So we have our journal entry set up. So on May 31st, we are going to debit bad debt expense. And when we debit bad debt expense, we're going to debit it for $6,250. How did we come about that number? Well, we had $125,000 in sales, and we believe that 5% of these sales will never be collectible. That's $6,250. Yes, we had a credit balance to bad debt before this started, but for this method, the percent of sales method, you're not working towards a target. You're always adding to it the portion of the current month's sales you don't think you're going to collect. So that $6,000 is just a number there to confuse you in this case, but it's to show that the percent of sales method you're not trying to get to an exact number. You're adding your percent of sales that you think are going to be uncollectible for that period to the existing number. So we're going to add 6,250 to it, which will bring our total balance of that account up to 12,250 when we make this adjustment to bad debt. In our next adjusting entry, we're going to adjust for some accrued revenues. On May 31st, Davis Golf Supply is going to have to make an adjustment for this contract that we have with a local community college. Under the terms of this contract, we are going to customize 12 custom golf bags for the college, and they're going to pay us $24,000 once they're all done and we've shipped them to the team. So we're getting paid at the conclusion of the contract. Well, when May ended, we haven't finished all 12 yet, but we finished 7. So we need to record an adjusting entry to accrue revenue. Why? Just like expenses, revenues have to go on the books in which you actually earn them. Well, we did some of the work during this period, so we have to put that revenue on our books during May. So what's the first account that's going to be affected? It's accounts receivable. Why? We finished 7 bags. Even if this local community college says we don't want the bags anymore, we're charging them for 7. It's going to happen because we did the work and it was part of our contract. So now they owe us something. And since they owe us something, we have to put it on the books at the time we know they owe it to us, which means we got to put it on May's books. The other thing being affected is service revenue because we provided the service to them. What type of accounts are these? AR is an asset. Service revenue is a revenue account. At this point, when we're making this adjustment, we're recognizing the fact that people outside of our business, our customers, owe us more money in total because this community college owes us for the 7 bags that we've completed. So AR has to be going up. And the amount of work that we did, the amount of service we provided by customizing golf bags also has to be going up. So we're going to have an increase to service revenue. AR as an asset is increasing, and all assets increase on the debit side. Service revenue as a revenue account is increasing, and all revenues increase on the credit side. So in our journal entry, we're going to start by debiting accounts receivable. And we're going to debit it for $1,400. And we're going to credit service revenue for that same amount in this adjusting entry for accrued contract revenues. Why are we adjusting for $1,400? Well, how'd I get there? The total amount of the contract is $2,400. It's for 12 bags. Well, we completed 7 of those 12 bags, which means they owe us 7/12 of the total contract value. Since the total contract value is $2,400, if you multiply it by 7/12, you come up with $1,400 in this adjustment.